Greetings once again, everyone. So now we have entered the leaves, and the leaves mainly speaks about price action patterns or patterns that reoccur around the charts where most traders will actually make their trades based upon. So what we are actually going to do right here is, since there is a lot of slides, we did not write down everything in the notes for you to skip it. We do hope that you actually go through all of it. So the main idea for these particular videos, starting from this particular topic, we will be just going through the animations and slides so you will roughly know how the flow and sequences of the slides actually work. And also, however, we will still make comments whenever it is applicable and whenever there is something important for us to say. So just a quick recap on what all of this is about. We actually want to redefine and explain the concepts behind price action patterns. So the main idea is for you to identify where the stop losses of the masses are located, okay? Where the stop losses of all the retail traders are located, because as we all know, this is a zero-sum game, and stop losses translates to liquidity. Okay, so I'm pretty sure you guys already know a lot about patterns. So let us dive into the major patterns that actually occur in the market. Okay, so there are bullish patterns, bearish patterns, neutral or continuation patterns. There are breakout patterns, reversal patterns. There are so many types of patterns, but we have classified it into these few categories. Okay, so maybe someone else will categorize it differently. It's up to them, but this is how we want to categorize it because we define it in this particular manner. Alright, so we have bullish and we have bearish patterns. So the whole idea about patterns is a lot of traders actually try to make out a story. They create a story out of patterns. For example, a double top. A double top means prices failed to make a higher high. So instead of making a higher high, it made a double top. And this actually shows that prices have lost momentum and therefore it will reverse. While technically this sounds logical to a certain degree, actually this is not what happens. Prices does not lose momentum. There's no such thing as momentum. Prices does not lose momentum. The reason why it did not make a higher high is because there was either not enough demand to exceed the supply, or the supply was so high that it shot back down. Okay, so these are the reasons why actually the market actually moves. And most traders don't actually explain this because they do not actually understand what it is all about. Okay, so let us get through to classic patterns. Okay, classic patterns comes in many shapes and forms. You even have diamond shape, you have wedges, you have cup and handles, you have whatever. Okay, you even have the harmonic patterns, but classic patterns are very geometric shapes. Okay, you have squares, you have rectangles, you have triangles, you have a combination of both. If you use the Elliott wave theory, it's actually a combination of triangles and rectangles, or even diagonal rectangles. So let's put this all aside, but I will actually explain something that a lot of traders actually think the charts are geometrical, okay? That prices move in a geometric order. Well, actually, this is somewhat true. It's not true, but not literally true. But why do we actually say it holds some truth in it? It's because when you actually search for equilibrium, when prices search for equilibrium, a lot of patterns will reoccur. And many things actually move and move. And in the end, it comes to a point where you can actually technically say that it is geometrical because there is a median. The median actually makes the geometry. Okay, so I wouldn't be talking too much about this, but what I want to actually emphasize is if you were to use any price action patterns, the easiest and the most logical ones for you to actually look at are classic patterns. Okay, so classic patterns are mainly made out of triangles and boxes. So it's up to you if you want to read this article. Well, however, if you want to gain a rough understanding on what price action traders are thinking, you can actually read it. So let's get into the first set of patterns, which are M's and W's. Okay, why M's and W's? M's make the double top and W's make the double bottom. Okay, over here you can actually see the first diagram. You can actually see prices making a double top, and the diagram below, prices are making a triple top. Okay, so you can actually see we start from the high, the first diagram, high, prices comes back down, goes back up. However, at F, it failed to create a new higher high. Then it broke out the neckline, and it retested the neckline before heading right down. Okay, so this is the whole idea of actually understanding double tops. Okay, for triple tops, let me explain the triple top before I actually continue on. Triple top, prices made a high, came back down, it failed to create a new higher high, and then on the third time, a lot of traders will actually try to enter a buy, since they think that, oh, the more the resistance is touched, the most likely it is to break. So a lot of them are making buy orders right there, and prices actually shot back down. Okay, so these two patterns are actually the sequence of manipulation. Where is it going to manipulate? Is it going to manipulate to the upside, where it's going to stop hunt all the sellers, or is it going to stop hunt all the buyers? Okay, so if you were to actually be a seller at this point, where will you be placing your stop losses? You will be placing your stop losses slightly above the resistance level, right? So if you're going to place your stop loss slightly above the resistance level, you can actually try to search for supply bases at that particular area. Okay, the same actually happens to M's and W's for double bottoms and triple bottoms. So where are you going to place your stop losses in this particular example? You are most likely going to put your stop losses just below the support, and just below the support there could be high liquidity, because demand may be located there, and that will make a better and higher probability trade. Okay, so I won't be talking too much about head and shoulders. Basically, I actually like to call the head and shoulders another variation of, it's just another variation of the triple top. Okay, so you can actually go through this yourself. However, I want to explain the third diagram. Okay, so the third diagram is common type tree, double confirmation, known as HHLL. Okay, so this actually is it's an infamous pattern. So a lot of traders actually confuse the HHLL as a head and shoulders pattern, because it actually looks like a head and shoulders pattern. But among all the types of head and shoulders pattern, the one that has the highest probability to actually work is actually the common type 3. Okay, the others work equally as much, but the one that grants the best risk to reward ratio is the common type 3. And we have explained it quite a number of times, and we will explain it also again in section 4, that this actually makes up the two-way trap. Okay, so let's get into a quick session over here, so you can actually study the flow of how the charts actually work, and from here, support and resistance, and marking out where all the patterns may be located. Okay, and from here, you can actually read this and study this on your own. And basically from here, these are just for classic patterns, but however, you can actually combine it with trend lines if you want to. You can combine it with fractals if you want to, and you can even combine it with harmonics. Okay, so the whole idea is, we are not pattern traders, and the whole idea of MINTEDSEED is not to actually make you become a pattern trader, but what we are actually trying to emphasize here is probability. Okay, as a price action trader, you are trading probability. Okay, you're not trading the orders, you're trading prices, and you're trading probability. So when you trade probability, you have to identify and understand which trades are the good ones and which trades are the bad ones. Okay, so a lot of people would like to include swings or market structures, lower highs, higher lows, and so on, and also marking their support and resistance, their trend lines. And over here, you can actually try to identify and read more on what is actually going in right over here. So basically, what is actually happening over here is we'll extend this same chart. Okay, basically this is the same chart as the next one. One moment. Yeah, it's the same one as this one. However, what we actually want to emphasize right over here is that if you look at the diagram at the top middle there, the retest of resistance now support. In section 4, you will learn that this actually is an order block on the lower time frames. But over here, it is known as a small demand zone. Okay, so in this particular area, we'll call it FTR, but we won't actually want to be calling it FTR. We don't actually understand why a lot of people are calling it FTR. It is not actually an FTR, it's actually a cluster. It's an area of orders. Okay, so we can actually skip all of that and let's dive into the three rising valleys, and the next one will be the three falling peaks. Okay, so this one is just a quick exercise. Typical analysis, prices making higher highs and higher lows. And over here is where you actually try to identify where the three rising valleys appear. So a lot of people actually think that three rising valleys means three higher lows. It doesn't mean three higher lows. It is actually a cluster. So if you take note at the zone mark, there are roughly three orders made, not literally three, but most of the time it will be three because it usually takes 3 times to scare off traders. Okay, so the reason why they actually put it 3 times is because many people will actually think it's going to be a flag where it will break to the downside. However, it doesn't break to the downside. It's actually a collection of orders to actually push higher up. Okay, you can actually see over here. You can actually even mark out all the classic candlestick patterns or classic patterns, price action patterns, and you also can mark out candlestick patterns if you want to. And over here you can actually go through and understand why do we actually emphasize what the three rising valleys is actually all about. So you can actually continue. This is the sequence of the slides, and you can read what is written in the notes to actually identify and understand what we are explaining here. Okay, and the next one will be the three falling peaks. And in the three falling peaks, this is how we actually explain, this is how the sequence of the animations are supposed to be. Alright, so the next one we have are pennants. Okay, pennants. We actually categorize every single, okay, based on the dictionary's definition, pennants means flags. So anything here, we are going to just generalize everything that looks like a pennant as a pennant. So if it's a retracement, a flag, a range, or triangles, or whatever, we will just categorize it under pennants. So starting in the diagram over here, let's first start from the symmetrical triangle. This is a consolidation type. Then the next one, you have a pennant, which is a flag type. Then the next one is also a pennant, a straight one, which is also a flag type, probably an order block. And the last one is a symmetrical triangle, ascending triangle type. Okay, so these are pennants. And over here, we will actually explain to you what are each symmetrical triangles, each pennant is all about. So over here, this is how we actually explain it. And we don't, although the explanation may seem very price action, okay, it may seem very price action, but the difference is we have included fractals. Okay, still remember what you actually learned in the recent topic, which is the twigs. You learn, yeah, it is the, if I'm not mistaken, it's a twigs, and you learn about Fibonacci ratios and fractals. So this is where another form of fractals actually come into play. Okay, so here you can actually see more about how fractals actually work. And this over here is a chart example on where you can actually locate triangles in the chart. Okay, so you can actually read over here what is actually going on. Also right here is another example on how triangles may form on the chart. So a lot of people actually think that this is the only way. If you actually see the small box at the right of the diagram there, downtrend continuation box. Okay, so most people actually think triangles only look like that. However, triangles can actually take a big portion of the entire chart. Okay, and not only that, if we talk about price action patterns, we also talk about probability. So probability is actually trying to add in different time frames. Okay, you have below, you have the chart below is the 15-minute time frame, and the chart above is the 5-minute time frame. And over here you can actually try to actually look at how prices actually move and correlate with one another. Okay, so based on this one, if you look at the 15-minute time frame, you actually notice that at the beginning there is a triangle, right? Okay, so how that triangle actually looks like on the 5-minute time frame is in the 5-minute time frame diagram above, right there at the top right corner. Okay, and these are more examples over here. Okay, so we are actually going to talk about over here. You can actually see triangle patterns. You can actually see some flags over here also. So these are more examples on this. We won't be going too much into this, but we will actually explain more on this in section 3 and 4. And if you notice, we actually have written there MPI. MPI actually stands for manipulation. Okay, that's where manipulation actually happens. So if there are, so like for example, the first manipulation at the bottom right there, at the bottom of this chart here, it actually shows prices touching the support 3 times, a triple bottom, right? Okay, so initially we were talking about where are the stop losses located. Okay, and if you go back to the end of the chart over here, you can actually look at that gray zone, which is resistance. Prices touch it 1, 2, 3, 4, 4 times. Okay, touched it 4 times before shooting up and creating an MPI, which is actually a manipulation where most probably supply is located at that area, and then prices gets pushed down. And the next type of pattern that we actually have are flags. Okay, so what do we actually define flags? Flags are actually where orders may be located. Many people actually say flags are corrections. They say flags are retracements. So, but we don't actually believe that the market actually requires any correction. Okay, so the only reason why flags actually happen, it's not because prices are losing momentum, it's because more orders are being placed. Okay, so this is one of the particular reason. And then you have wedges and channels. Okay, so what are channels? Okay, channels and wedges are very closely related, only that wedges, it wedges at the tip. Okay, so instead of being parallel to the support and resistance trend lines, instead of being parallel to one another, it actually squeezes towards the end, so it becomes a wedge. But basically it is the same thing. And over here you can actually read and understand and check out more examples on what we are actually talking about. And then finally we have some minor patterns. So minor patterns, there are many forms. It comes in diamonds, you can read about this yourself, and this is a chart example on diamonds. Alright, here's another chart example, and diamond patterns can actually be found. Basically, if I'm not mistaken, this is a 5-0 harmonic pattern, and the 5-0 harmonic pattern actually makes a diamond. Okay, so you don't actually have to go and research this. You don't actually have to search this harmonic pattern yet, because we will actually explain this in the following topic. So relax, you don't have to research it, because we don't actually want you guys to use harmonic patterns, as it can be very deceiving. Then after that, these are newer versions, cup and handles, scallops, and over here you can actually see how it actually looks like on the charts. And if you were to actually replace it with diamonds and so on. So basically all the technical analysis is very similar to one another, only that you are using different patterns and different tools, but the outcome is most likely to be the same. Okay, and then you have megaphones or broadening wedges, which is basically a wedge but moving on the opposite side. So you can actually read what we have written here to understand a bit more on what prices are actually doing when a megaphone or broadening wedge actually happens. So this is a chart example. Scallop to parabolic curve. If I'm not mistaken, most MT4 platforms have this indicator known as the parabolic SAR. Okay, so that is, don't try to open that indicator, it's a waste of time, so don't even bother. So however, it is actually the whole idea for that indicator is actually for you to identify parabolic curves. Okay, however, the problem is you rely on the indicator, the parabolic SAR. So we do not actually want you to use the indicator, because most of the time parabolic curves happen because of imbalances. Okay, so if imbalances actually happen, prices are bound to find for the balance. So in this particular case, you can actually see bases being made, you can actually read all what we have written over here. However, if you look at the target zone is where the imbalanced up move actually happened, and the target zone is where you actually are going to place a sell. You're going to place a sell, and your target will be back at the origin of imbalance, because that's where prices eventually will balance itself out. Okay, not literally, but we will explain more on this in section 3 and section 4. So this video was actually meant for the sequence or on how the animations actually work. Okay, so time to make a recap. In this topic, you will learn about classic patterns, modern patterns, a bit more about supply and demand, and soon we will come into harmonic patterns. So before we actually end the leaves, let us tell you that patterns can be subjective, and patterns are actually imaginary. Okay, it is imaginary. So let me give you an analogy before we actually end. Let us give you a quick analogy on why we actually say patterns are imaginary. If you actually go to a grocery store to buy a bottle of milk, all right, are you actually going to look for double top patterns in the price? You're not going to look for that, right? You're actually going to look for the best quality of milk at the best price. So I'm talking about prices, best price. Where are the best prices located? So this particular grocery store has determined that this particular bottle of milk is supposed to be sold at $5, because $5 is what most customers are willing to pay. So that is why $5, that particular level of $5 has the most liquidity. Okay, I'm speaking this in layman's term. This for $5, that's where most liquidity is located. So a lot of customers will buy at $5. Okay, they buy at $5 because it is quality, there is quality, and the prices are good. Okay, they do not actually buy it because they saw a pattern somewhere or someone actually told them about it or whatever. But the whole idea of me actually explaining all of this is for you to identify where the stop losses are located and try to think it differently. And basically what we have actually done in this particular topic, it may be similar to others, but if you read between the lines, we actually drop quite an amount of hints to why and the reason why all these patterns actually exist, and how you can take advantage to also be part, not be part of the institutions, but you can actually understand how manipulation actually works and not to literally be a price action trader. Okay, I'll see you in the next one. This is the end of leaves, and the following topic will be flowers. Thank you once again.